The cybersecurity market is expected to be over $500 billion over the next few years, growing at a very strong rate year on year. And in today's episode, we want to take a look at some stocks that can benefit from not just AI, but also the cybersecurity market. We're going to look at a few companies. We'll look at how they've performed over the last few years. We'll do an in-depth look at some of their financial metrics to ensure that these are some strong companies to consider in your portfolio, covering both AI as well as cybersecurity. And as always, we will run through each one of these into the valuation model. We want to get to the intrinsic value. We want to find out what our acceptable buy price is, factoring that margin of safety, and as well as seeing what Wall Street thoughts are for their price target over the next 12 months. What we're also going to do in today's episode is consider a few ETFs for those that don't want to pick any single stocks. We'll take a look at two cybersecurity and tech ETFs that you may not have heard for, take a look at the details, see what their expense ratio is, and see what their holdings are to ensure they are covering up some very strong stocks. So let's jump in with the first one. Now this is CrowdStrike Holdings, ticker symbol CRW. Now over the last 12 months, an incredible performance, up 174%. We can see over the last 52 weeks, they are trading towards the upper end of that range, and they do have a forward P of just under 85 with a market cap of 80 billion. Now, if you've been holding this over the last 5 years, we can see it was in 2019 around $64. So it has been on an incredible run to date. So let's take a look and see if this is a company with some strong financial metrics. Free cash flow from 2017 for the first few years, we did see negative free cash flow per share. It then has picked up very nicely. And what I'd love to see here is that consistent increases year on year. From 2020, there are no essential inconsistencies, and we can see in 2024 that 389 free cash flow, 2025 expected to go higher, so the growth is expected to continue with CrowdStrike Holdings. I do love to start off on some very positive metrics. Sales growth, now what we can see here, triple digit growth to their top line in 2018 and 2019. Yes, it has been slowing down. Nonetheless, 2024 36% increase to their top line is a very strong indicator that this is a company that is still growing at a very rapid rate. And you can clearly see this when we look at the numbers. 50 million of revenue in 2017, and it has astronomically gone to over 3 billion in 2024. So this is a company that continues to increase on that top line year on year, and there are no reasons or indicators that we have noticed for this to slow down anytime soon. Now taking a look at their shares outstanding, what we do know, however, they would have diluted your position over the last few years if you were holding this company, increasing shares outstanding from 40 million to 244. But again, bear in mind the share price has increased pretty strongly, so maybe this wouldn't be a massive worry at this point in time, but something to consider nonetheless. ROIC, now we see over the last few years it is negative given the fact, and as we're about to find out on the margins, they have been making a loss. 2024 at 0%. Obviously, you know, for us, we want to see at least 10% as a minimum on this side, but companies that are fast growing in the initial stages, we do note that the ROIC does start to lack. Something just to bear in mind though, and we can see they have essentially broken even on that operating margin line in 2024 with a 0%, and it has gotten a lot better year on year from the initial negative 172%. On the flip side, when we do focus on that free cash flow margin, we can see the consistency over the last 4 years at 30%. If they manage to keep this up, alongside turning that operating margin into a strong positive, then this could be a very strong contender for your portfolio. And when we take a look at their debt to EBITDA, the earnings before interest, tax, depreciation, amortization, what this signals to us that over the last few years, as well as expected next year, it won't even take them one day to pay off all of their debt net of cash on hand. A very strong balance sheet therefore. So lots of positive metrics, a few things to consider for CrowdStrike Holdings. So let's jump into the valuation of this company. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through every single one of these models. For today's episode, we're going to jump straight into the intrinsic value. And for today's episode, this is just essentially the DCF valuation, which gets to a price of just under $400. Now, the way we work with this, remember, margin of safety, we use a 10% to start off with, and we use it if it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. We keep going till it's near the current trading price, and we can see it is a few dollars away. So we see for CRWD a 15% MOS level based on our estimates and judgments. In terms of Wall Street and their forecast, well, they have a price target not too dissimilar from our intrinsic value at $393, with upside of 18%, believing that this company, which has been on a very strong run so far, is still a very strong buy. As always, as we go through these companies, do give us your thoughts. Let us know if you are adding any of these or whether or not you are putting these on your watch list. The next company that we are taking a look at is Fortinet. Now, this is one that over the last 12 months has been decent, up 18%, maybe not as strong as the others that we have seen, like CrowdStrike Holdings. Over the last 10 years, we can see, however, a different story, up an incredible 1,406%. It is trading in the mid to upper end of the 52-week range with a forward P of over 40 and a market cap sitting at $54 billion. Now, in terms of those metrics, in fact, over the last 10 years, they have been positive on the free cash flow basis. 20 cents in 2014, strong growth year on year, 222 in 2023, although we do see the expectation for a little drop into 2024. Nonetheless, sales growth top line very consistent around that 20 to 30% level year on year. The more recent year at 20% showing signs that this isn't a company where the top line growth is slowing down anytime yet. And we can see $770 million in sales to just around 5.3 in that 2023 year. They also do share buybacks. They also dilute your position. The net position, however, over the last 10 years is reducing that shares outstanding. So they do return that excess cash to investor pockets, essentially giving you a larger piece of the pie. So that is positive to note. On top of that, ROIC, absolutely phenomenal. Over the last 2 years, we're talking triple digits. It has been a while since we've seen any company that has triple digits, and we can see from 2014 it is looking like growth in nearly every single year. Absolutely phenomenal. Definitely one that you should pigeonhole as something to come back to compare when you are looking at other companies. Very, very strong. Operating margin, I like to see this. It is fairly low in 2014, so we are noting operational efficiency. It has increased over the last few years. 23% is very respectable in 2023. And the free cash flow margin, lots to love, well above the minimums we want to see. And 33% over the last 2 years, very attractive for an investor. Net debt to EBITDA, there isn't really too much else you could want from this company. It wouldn't even take them 1 day to pay off all of their debt net of cash on hand every single year and for 2024 expectations. So looking very positive on that front. In terms of the valuation, let's get to it, and don't forget you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. Margin of safety of 10%, then a buy up to $78. At 15%, we can see up to $73. 20%, not quite there yet, but really not that far off. So we see a 15 to 20% MOS level for Fortinet in today's price. In terms of Wall Street, well, they forecast 21% upside, $85 expected over the next 12 months, making this similar to CrowdStrike Holdings a very strong buy in this market. The next company that we are taking a look at is Palo Alto Networks. Now, over the last year, up 56%. We can see pretty much in the midpoint of the 52-week range with a forward PE just over 50, a market cap under 100 billion, and over the last 10 years, up a very strong 1,000%, although we can see it did peak around $377 towards the beginning of this year. So let's take a look at the numbers. Well, again, very strong growth over the last 10 years, positive every year as well, from 23 cents to 8.68. 2024 expected to increase as well, always positive to see. So really like what we're seeing on this episode so far in terms of the free cash flow. Sales growth, whilst it does look like it has slowed down from 2017, it has been around that 20 to 30% every single year to the top line. 2023, again, more of the same with a 25%, so lots to love there. And we can see 600 million, they've more than 10 times their top line to just under 7 billion in 2023. We do unfortunately have to note that they have diluted your position over the last 10 years, increasing from 223 million to 342, something just to bear in mind. And the ROIC, as we will about to find out, the operating margin is negative, but 2023 we have the first year of positive ROIC, trailing 12 months 11%, very positive. Remember, we want to see ideally a minimum of 10%. And as we said here, we can see that they have had a negative operating margin until 2023, where we saw a 6%. Not ideal, we do want to see a lot higher, but positive to note that it has finally switched to the positive side. And free cash flow from 2015, absolutely strong, a very good free cash flow machine for investors, and 43% very attractive in 2023. Net debt to EBITDA, nothing really to note. Again, 0 for the majority of the last 10 years, 0 in 2023, 0 expected next year. A phenomenal balance sheet, which seems to be a common theme with these companies we have taken a look at so far. In terms of their intrinsic value then, again, we will take a look. It is just the DCF model at $382. When we take a look at the margin of safety at 10%, we see a buy up to 344. 15% still showing a buy, so we can see with this company there is a sufficient MOS level between 20 to 25%, but again it will depend on the individual investor's thesis and their risk profile, as well as their goals and a few different other things to consider. In terms of Wall Street, well, again, a third company with very strong buy indicators, upside of 21%, and their price target of $350. As always, let us know your thoughts in the comments below. We then take a look at company OCTA, ticker symbol OKTA, up 32% over the last 12 months. And we can see, in fact, when we take a look at the last 5 years, it is up 30%, although we do note it has been as high as just under $300 over the last few years. However, over the last 52 weeks, it is trading towards the upper end with a forward PE of 48.45 and a market cap of around $18 billion. Now, this is one where it did have negative free cash flow for the first 5 years that we can see here on the screen. From 2020 onwards, though, we do see positive free cash flow, a very strong increase into 2024, and again, 2025 expected to increase from that very nice position. So free cash flow looking pretty strong. Again, we do note, similar to some of the other companies, it does look to be decreasing. Nonetheless, though, their sales growth of 22% in 2024 is still very strong. But we do want to ensure that 2025, their guidance that management are giving, doesn't show a large slowdown in terms of their top line. Total sales, $40 million in 2015, $2.26 billion in 2024, very strong. Again, with companies, we do typically see this, as we have seen so far on this episode. The shares outstanding has decreased. But again, for some of these companies, always factor in whether or not that share price is also increasing at a faster rate. We will now take a look. Operating margin is sure to be negative, as we can see the ROIC for this company has been negative for the large part of the last 10 years. And we can see, whilst it was a very, very large negative 143%, it has gone a lot smaller to negative 20%, and we would like to see an operating margin positive over the next few years. In better news, we see the free cash flow margin turn positive from 2020, and 22% is looking very strong and healthy in 2024. Net debt to EBITDA, they had some struggles that we see from 2018 to 2020. Since then, though, 0 every single year for the last 4 years and expected next year. So again, similar to all these companies, their balance sheets do look to be in a very strong position. So let's take a look at OCTA's valuation. Don't forget, if you do enjoy this content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified as they drop. Margin of safety of 10%, then we can see it isn't quite there yet. Not too far off, a few dollars, so we would say it is around a 10% margin of safety at the $107, $108 mark. In terms of Wall Street and their forecast, well, they see a price target of $115 with upside of 5%. So whilst they do see some nice upside for this company, it is one of those that has single digits. Something to consider, but as we always say, never ever look at Wall Street's forecast and take it as certain. Always factor this into your investment thesis if you like, but always take it with a pinch of salt. The next stock that we are taking a look at is Sentinel-1, ticker symbol S. Now, over the last year, up 100%. Over the last 5 years, we can see in 2021, it was priced at $42.50, went up to around a peak of $77, and it has come down since. Nonetheless, it is in the mid to upper end of the 52-week range with an incredibly high forward PE and a market cap of around $8.4 billion. Now, in terms of the metrics, we can see the free cash flow has been negative for quite some time, although they are expecting positive free cash flow in 2025. One thing that's important to remember here, you'll see from all of these companies, you'll note that the share price did start to increase rapidly when their free cash flow did turn positive. So something just to consider if you're happy to buy a company with a little bit of speculation, or if you essentially want to wait to see a few years of positive free cash flow. In terms of the sales growth, well, they are increasing at an incredibly rapid rate. 3 of the last 4 years, triple digits, and 2024 a still very strong and respectable 47%. And it's gone from around 46.5 million in 2020 to 621. Shares outstanding, they have increased and diluted your position over the last few years. In terms of ROIC, negative every single year bar 2020. So again, this isn't no surprise. The operating margin, they haven't turned an operating income yet. It is an operating loss. Negative 60% in 2024. The only positive to say is that it has been reducing over the last few years. And if it does continue to move in the right direction and it does turn around into a positive free cash flow for a few years, as well as positive operating margin, this share price will be significantly higher in the future than it is today. Free cash flow also moving in the right direction, nonetheless still negative in 2024. Net debt to EBITDA, just something to consider. 2024 8.39 is significantly high. A little bit of a red flag indicator, but something to consider. And this may surprise you when we take a look at the ETFs, but this is one of the top 5 in terms of the holdings of these ETFs. So let's jump into the valuation of this company, get to the intrinsic value for today's episode, and we can see it arrives at a $30.29 intrinsic value price. With the current price around $28, the margin of safety then at 10%, it isn't quite there yet, not too far off, so around a 10% MOS level for SentinelOne in today's episode. In terms of Wall Street and their expected price, well, $29.40, so they do see upside, however very limited for 5%, around the same level as OCTA in today's episode. Just to let you know, we have released our latest free weekly article, completely free. If you want to gain access to this or any of the other articles that we have written, all completely free by clicking on the pinned comment below, and you can gain instant access. Now, the first ETF that we're going to discuss today is the iShares Cybersecurity and Tech ETF, IHAK. Now, one thing to note with these ETFs, they do have a slightly larger expense ratio than maybe the others that you do hold or have considered. This, however, is one of the lowest in this cybersecurity and tech industry, 0.47%. Now, in terms of their holdings, now remember we did discuss some of these. Their top holding we have here is OCTA Inc. Now, that is around 5.22% in terms of the weight. Their second is CrowdStrike Holdings, which again around the 5% level, and we did cover that today. SentinelOne, again another one we covered, and Fortinet. So in fact, the top 4 we did cover today. Those are their largest holdings. Number 5 coming in at CyberArk Software. Now, as always with ETFs, you may not get the exposure in terms of the upside of just holding one that does very well, but you also restrict the downside. So, for example, if any of these companies that you were to purchase went down 50% by holding the ETF, it wouldn't affect you as much. As we can see, the largest holding itself is just 5%. The next ETF to consider is BUG Cybersecurity ETF. Now, when we compare it to the initial one that we had of around 0.47 expense ratio, we can see this one is a little bit higher at 0.51%. In terms of their holdings in comparison, we can see very similar. However, there are 1 or 2 differences. CrowdStrike is one of their largest holdings, however, a much larger position at 8.2%. They have SentinelOne, which we also analyzed today, at 6.22%. They then have Gen Digital and Zscaler, which we didn't analyze today, around 5 to 6% holdings. And then below that, we have the other ones that we looked at, Fortinet, OCTA, and we can see Palo Alto Networks here as well. Now, again, it does really depend whether or not you want to buy these companies individually or within an ETF to be secure. Remember, with an ETF, that whilst you do get essentially exposure to many different holdings, as we can see, this is just around 8%, you do have to understand that the expense ratio is there as well, which is their management fee as well as other fees at around 0.47 to 0.53%. Lots of different factors to consider. I'd be interested to hear your thoughts whether or not you are more inclined to invest in ETFs, especially in industries where maybe you may not have as much information available to you or you don't have the knowledge there, or whether you do like to pick certain stocks within certain industries like CrowdStrike or SentinelOne. As always, let me know your thoughts in the comments below, whether or not you enjoyed this episode, you like to look at certain different industries, whether you want us to cover different ETFs or anything, and we will take that on board and consider that for our future videos. As always, have a great day. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to those free weekly newsletters, and as always, we'll see you on the next one.